The Federal Reserve is supposed to raise interest rates going into 2022. Will this create a stock market crash? I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over these huge announcements from the Federal Reserve from December 15th of 2021. First of all, actually we got to go back a couple weeks earlier. And Jerome Powell dropped the word transitory. So he is now admitting that the consumer price inflation we have seen in 2020 and 2021 is not going away anytime soon. The next thing they announced is an additional $30 billion worth of tapering. Remember, they started with $120 billion a month in quantitative easing. This was after the cerveza sickness. And then they dropped it down by $15 billion. So they are still doing $105 billion per month, but this was considered less QE, therefore the word taper. It doesn't necessarily mean the Fed is reducing the size of its balance sheet, just increasing it at a slower pace. The third announcement was they said they could possibly increase interest rates 3 times in 2022. So they'd have to take the size of quantitative easing from $75 billion, that's including this $30 billion of additional tapering, so 120 to 105 to 75, down to 0, and then going into 2022, maybe June, July, they start increasing interest rates, and they say they could increase interest rates 3 times moving toward the end of 2022. So what I want to do in this video is really think through the consequences that may have on the stock market. So let's start by going over what tapering or quantitative easing actually is. We've got the Federal Reserve right here, the balance sheet, assets on the left, liabilities on the right. When the Fed does QE, what they're doing is buying treasuries or mortgage-backed securities from XYZ Bank. We'll call it JP Morgan. So those treasuries the Fed purchases go onto their balance sheet. They're now an asset. Well, how does the Fed pay for that? They don't send them a basket full of dollars via FedEx. They don't send them a Brinks truck full of green pieces of paper. What they do is they credit the account that JP Morgan has at the Fed with additional bank reserves. And these bank reserves are denominated in dollars. So all this really does is increase the balance sheet capacity that JP Morgan has for lending. But they're not really balance sheet constrained in the first place. So it's kind of just a balance sheet transaction, or as Jeff Snyder says, an asset swap between the Federal Reserve and, in this case, JP Morgan. So what the Fed is doing by saying that they're tapering is this process of buying treasuries or mortgage-backed securities is just going to be reduced all the way down to 0, and then they'll start raising interest rates. Well, the next step is to understand how they raise interest rates. It's not like they have control over every single treasury throughout the entire curve. They might control the short end of the curve, maybe like the 3-month, the 1-year, the 2-year to some extent, but they don't really control the 10-year and the 30-year. That's more controlled by market forces. So let's think through how they try to control the Fed funds rate, or what is now called IOR, interest on reserves. So all these bank reserves that JP Morgan has in their account at the Fed pays them a rate of interest. And this is how they try to micromanage the interest rates that JP Morgan charges in the repo market, as an example. So if they have interest rates at, let's say, 5 basis points, let's say 1% to make it easy, that would mean that JP Morgan has a complete risk-free return of 1%. Therefore, to get them to lend money into the real economy or create additional loans in the repo market, they would charge more than 1% because there's going to be a slight amount of risk there, or maybe there's going to be a lot of risk there, which would create a risk premium on top of the 1% they're being paid at the Fed. So to make it simple here, They get a complete risk-free 1%. So the only thing that would incentivize them to actually lend money is if they were getting an interest rate higher than the 1% they're being paid at the Fed. And just so we're all on the same page here, the Federal Reserve can increase interest rates through IOR, but they can also lower interest rates through IOR. So you have this cause and effect on the yield curve for the Treasury market. And we'll get into that in just a moment. But what I want to point out beforehand is this chart of CPI. This is consumer prices as measured by the government. And I always have to put in that footnote because this understates prices in the real economy dramatically. But let's just use this as a benchmark. This goes all the way back to 1965. And I was doing great here, but you can see I ran out of room. So the years kind of get compressed at the end of this chart, but you can get the gist of it. So it goes from 1965 all the way to today's date. On the left, we go from consumer prices going up by 0% all the way up to 15%. Now, you guys know what happened in the 1970s. We had big spikes of inflation. Then Volcker came in and really jacked interest rates up to 18, 19%. That broke the back of inflation. And since then, it's kind of been just a straight trajectory down until this point, which is really during the cerveza sickness. And since then, we have seen the CPI, even as measured by the government, go completely parabolic. Another thing I want to point out is this red line signifies core CPI. So it's minus food and energy. When you look at just the normal headline CPI number, it can have some volatility. Editor, go ahead and throw up the chart, and you can see what I'm talking about with this blue line, especially during the GFC. It's kind of going up and then down dramatically. But the core CPI is much more smooth. And I think it's very interesting that this is the first time, really, that we've seen core CPI spike since the 1970s. So I think there's a lot of political pressure coming down from the administration on the Fed to make inflation go away. There's one thing that can almost guarantee a politician not being elected in the future, and that's severe consumer price inflation, especially the price inflation that people see every day, such as food, energy, and shelter. But let's get back to this yield curve. We've got 3-month, 2-year, 10-year, and 30-year treasuries. So this is the yield on those treasuries currently. This blue line shows that the curve currently is gradually steepening, meaning that the 10-year, or the further you go out, the 10-year would pay you a higher yield than, let's say, the 2-year treasury or the 3-month treasury. This is how a healthy yield curve is supposed to look. But what happens when we get an inverted yield curve? So this is when, let's say, the 2-year treasury pays a higher yield than actually a 10-year treasury. We talked about this in last week's whiteboard video. But when we see an inversion in the treasury yield curve, it's got about a 90% probability of the United States economy going into recession within the next year or year and a half. And usually with a recession comes a stock market crash. So to put all the pieces of the puzzle together, and this is something that really nobody is talking about right now, let's think through tapering and also think through IOR in terms of what that's done to treasury yields throughout history. Editor, let's throw up a chart of the Fed's balance sheet going all the way back to 2007. And let's compare this to the yield on the 10-year treasuries. And what you would assume is when the Fed is increasing their balance sheet, in other words, buying treasuries, that would create more demand. Therefore, the price of the treasuries would go up and the yield would go down. But counterintuitively, what we have seen since 2008 and the initiation of the first round of quantitative easing is actually the opposite. So when the Fed increases their bond buying or increases the size of their balance sheet, the yields on the 10-year treasury usually go up, not down. And when they decrease the amount of QE they're doing, or if they decrease the size of their balance sheet where they're actually selling bonds into the market, we see interest rates then actually go down. It does the opposite of what you would think. But the thought experiment doesn't end there. Let's go back to IOR. So in this world in 2022, the Fed reduces the amount of quantitative easing down to zero, and then they raise IOR 3 times. So let's say they go from 0 up to 75 basis points, or from 0 up to, let's say, 1%. So what this is going to do is this is going to increase the yield at the short end of the curve. So we go from the blue line potentially up to this red line. Now I've got the red line at 2%. Why? Because the Fed also came out and said that they not only would probably raise interest rates 3 times in 2022, but then they said they'd also raise them twice in 2023 and twice again in 2024. And I was just estimating that that would get us right around 2%. But this is really to give you a visual of what this would look like on this yield curve. So the front end, the interest rates go up. But what happens to the long end of the curve? Remember, that's more market driven. And let's also remember that when the Fed reduces the amount of quantitative easing, usually interest rates at the long end of the curve, the 10-year and the 30-year, don't move up. They usually stay flat, if not go down. So if interest rates at the front end of the yield curve are going up, and interest rates at the long end of the yield curve are staying flat, if not going down, we get an inversion of the Treasury curve. And like I said earlier, this means 90% plus that we get a recession going into the next year or year and a half. And usually with that comes a stock market crash. Whoa, time out. I know many of you right now are asking yourself, boy, where did George's snappy looking colored shirt go for this video? Well, today I'm wearing none other than my Rebel Capitalist t-shirt. And I wore this t-shirt specifically to remind you that Rebel Capitalist Live is coming up January 7th through the 9th in Houston. So you gotta get your tickets now before we are sold out. We're gonna have incredible speakers such as Ron Paul, Chris Cole, Lynn Alden, Richard Werner, Robert Kiyosaki, just to name a few. So to check out the list of speakers and to get your tickets right now, check out rebelcapitalistlive.com. Step number 2. Okay, I know a lot of you right now are saying, okay, George, I get it. The Fed might make the yield curve invert, and that's bad news. And if they raise interest rates, that usually means that future earnings for corporations go down, and the PE multiples compress, and therefore stock prices go down. I get all of that. But what's going to happen is the Fed's going to come in just like they did in 2008, 2009, just like they did in 2020 of March, and they're going to just do more quantitative easing. It's the same old story. I've seen this movie before, and I know how it ends. There's a Fed put. So who cares if the market goes down temporarily? The Fed will come in and save the day. Unfortunately, this view misses a couple key points. Let me explain. Got a chart going all the way back to 1980. 2021. This is the S&P 500 adjusted for inflation. So during 1980, when Volcker jacked interest rates up to 18-19%, the stock market did go down. In nominal terms, not that much. When you adjust for inflation, it went down significantly, maybe 20%, 25%, but not much in nominal terms. In 1990, the stock market went down when we had an inverted yield curve about a year prior. Then in 2000, we know what happened. The dot-com bust, it all came crashing down. S&P lost about 50% of its value. And again, this is adjusted for inflation. GFC down 50% again. In March of 2020, stock market down again, maybe 30, 40%. But to your point, that viewer who's kind of pushing back on my thesis here, it is true. The Fed came in and kind of saved the day in 2000, GFC, and in March. But maybe not. Let's think about this. When the Fed came out with their put, remember this was a Sunday emergency meeting when the stock market had been crashing and they announced they're going to drop interest rates down to 0%. They're going to do QE infinity. They're going to commit doing up to $1 trillion a day in the repo market. But what did the stock market do the very next day? It was down by over 1,000 points. And the stock market continued to go down until the government came out and announced the CARES Act. Massive deficit spending to the tune of $4-5 trillion. So I think what we saw back in March of 2020 is the Fed put expiring and the market moving on to a government put. But again, I know a lot of you are saying, okay, George, so what? We've gone from a Fed put to a government put. If the stock market goes down in 2022, the government will just come and send out stimmy checks, PPP, who knows what they'll do. They'll flush the US economy with dollars, and therefore most of those dollars, or a lot of those dollars, will go into the stock market, and it'll bring it right back up, the same government put we saw in 2020. But there's one key element that this view is missing. So let's go back to our chart of CPI, 1965 to 2020. Look at this line, starting right here in about, let's say, 1983. And again, this is core CPI, which is less volatile. It excludes food and energy. It pretty much went straight down all the way to the middle of 2020. And I kind of drew the line here so you could compare it to this chart. CPI going straight down until we get to the middle of 2020. Since then, as you guys all know, because you go to the grocery store, you pay rent, or you put gas in your car, CPI or consumer prices have gone straight up. They've gone parabolic. So let's think about this for a moment. Every single time we've had a stock market crash for the last, let's say, 30 years, it is true the Fed or the government has stepped in with a put. They've done something that gets the stock market going back up. But we've also been in an environment where inflation, as measured by the government, has been going down the entire time. So now we're in an environment where inflation isn't going down, it's going straight up. So what happens if the government comes in and spends an additional $5 trillion in deficit spending by sending out stimmy checks, PPP, etc.? Well, this exacerbates the consumer price inflation that we already have. And if consumer prices in the real economy continue to go up, that means the probability of the current administration being reelected goes straight down. So they are going to be incentivized to not print the money required for the government put. And they're also going to have massive influence over the Fed. So if the Fed takes their QE down to zero, starts raising rates, the market tanks, the Fed comes in and says, okay, we'll try to come to the rescue. But the administration comes in and says, whoa, time out, Fed. If you stop raising interest rates, or if you drop interest rates back to zero and start quantitative easing again, the public will see this as though you're stoking inflation. And then I'm not going to get reelected. So the government has a massive influence over the Fed, in my opinion. So that will prevent the Fed from doing what they need to do to prop up the market. And then, of course, the administration, like we said earlier, is going to be incentivized to not prop up the market. They're really going to be in a difficult situation. It's a catch-22 where you're damned if you do, damned if you don't. You're backed up into a corner where the only thing you can do is steal purchasing power from the average Joe and Jane. Because if you raise interest rates, you're going to steal purchasing power by the stock market going down. But if you don't raise interest rates, you're going to steal purchasing power by the prices of goods and services continuing to go parabolic. So the bottom line from step number 2 is that you realize if the stock market collapses, there might not be anything the Fed or the government can do about it. Step number 3, there are always cross currents. And what I mean by this is, as we discussed in step number 2, there's going to be some serious headwind for the stock market if the Fed decides to continue with their tapering and increasing interest rates. But it doesn't mean that it's the only force at play. While there could be significant headwinds going into 2022, there also could be significant tailwinds to the stock market that are created by the policies we discussed in step number 1 and step number 2. Let me explain. This weekend, I was hanging out with my good buddies, Brent Johnson and Peter Schiff. And Brent and I started talking about what would happen if the Fed started to raise interest rates and the stock market crashed. Exactly what we're discussing in this video. And we both came to the conclusion that yes, there is a probability, it's far above 0, that the stock market would crash. But there's also a scenario that may play out where the stock market would explode even higher than it is today. Here's what we talked about. We've got the United States, obviously. You can see Florida right there. And the United States, we've got the Federal Reserve. They're talking about increasing interest rates. So that means the borrowing costs for entities inside and outside of the United States most likely increases. But while this is happening, the global economy is slowing down significantly. We're seeing less global activity. And this is something we talked about with the euro-dollar future curve prediction in last week's whiteboard video. But as an example, we've got Europe, a lot of countries going into lockdowns, increasing their mandates and creating further economic distortions. Well, if the global economy slows down or if activity output decreases, that means the amount of dollars in the global economy that are circulating, the velocity of those dollars goes down as well. Well, if the dollars in circulation decreases, that means that the dollar cash flow coming into foreign entities and corporations with dollar-denominated debt decreases as well. So let's think this through. We've got one of my favorite countries on the planet Earth, Colombia, right here. Corporation XYZ. On the balance sheet of Corporation XYZ, we have assets and liabilities. On the liability side, let's say we've got dollar-denominated debt. And let's just say that there's $1 billion worth of dollar-denominated debt on the liability side of Corporation XYZ in Colombia. Well, let's just assume usually their dollar-denominated cash flow, their profit, in other words, the profit they're making in dollars is about $1 billion as well. So they've got the $1 billion of cash flow to service the $1 billion of debt. And to make this even easier to understand, just for a moment, let's just assume that these are their actual payments. So every single month, they've got a dollar-denominated debt payment to the bank for $1 billion, and they have $1 billion a month coming in dollar-denominated cash flow or dollar-denominated profit. So if the global economy slows down, like the euro-dollar future curve is predicting, we have less profit coming into Corporation XYZ. Well, if their dollar profit goes from $1 billion a month, let's say down to $500 million, their debt payment remains the same. So how do they make that $1 billion a month debt payment if they only have $500 million in dollars every single month coming in? They have to go to the asset side of their balance sheet and sell something to get the dollars they need to make the monthly payment to the bank. So most likely the asset side of Corporation XYZ's balance sheet has Colombian pesos. Because although they do business denominated in dollars where the transactions are settled in dollars, they do a lot of business where the transactions are settled in Colombian pesos. So they take those Colombian pesos, they go into the FX market, they buy dollars to pay the bank. Well, this increases the supply of pesos circulating in the global economy, and it increases the demand for dollars, which does what? It makes the dollar appreciate in value against the Colombian peso. So right about now, I'm sure a lot of you are asking yourself, okay, Georgia, what does that have to do with the US stock market? Well, insert this gentleman right here. It is not Warren Buffett. Oh, no, no, no. But it is Warren Buffett's Colombian cousin. That's right, Warren Escobar. So Warren Escobar is a very sophisticated investor. And he has a lot of Colombian pesos on the asset side of his balance sheet. And he sees what's going on in the global economy with the dollar-denominated debt because he's watched Brent Johnson's dollar milkshake videos. He gets the dollar milkshake theory very, very well. So he says, my gosh, these pesos on my balance sheet are going to lose a lot of value in the upcoming months or the upcoming years. So I need to do something with my pesos. Just like a lot of you who have dollars in the bank say, I need to do something with these dollars because they're going to be losing a lot of value or purchasing power in the future. So he looks around Colombia and says, boy, I don't want to invest there. But if I remember my economics 101, supposedly stocks are a good hedge against inflation. And although Warren Escobar is a very sophisticated investor, like all of us, he has recency bias. So he sees Apple, Google, Facebook just going parabolic over the last few years, and maybe he assumes that's going to continue to happen. Plus, stocks are a good inflation hedge. And maybe most importantly of all, Warren Escobar believes in the Fed put. How do I know this? Because he's holding a sign that says Fed put es muy bueno. So he thinks the Fed is going to come to the rescue even if the market crashes. So he takes his pesos, goes into the market, buys stocks, which gives the stock market a tremendous tailwind if there's hundreds or thousands of people like Warren Escobar that have the exact same idea outside of the United States. So this is a tailwind that's being created if the Fed creates the headwind that we were talking about earlier in the video by increasing interest rates. Hopefully you can tell that this video has nothing to do with making predictions. It's trying to get you to think properly about the global economy, about macro, about the domestic economy, about the dollar, to really make better decisions, not based on certainties, but based on probabilities moving forward. And if you look at the world in these terms, understanding that it's only a matter of probability, and there are always cross currents that are pushing up on inflation, down deflation, that they're pushing the stock market up, the bond market down. There's always these cross currents at play. You are going to make better financial decisions in the future. And most importantly, you are going to have an edge when it comes to investing, which means the longer you invest, the odds are in your favor that over the long run, you are going to make money. And maybe even more importantly, you are going to be prepared for whatever 2022 has in store for us. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.